identifying whether you're in a bull environment or a bear environment is central to interpreting how much you need to worry about the resetting of indicators.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pains.
That's going to be bonkers. Welcome, everybody, to another episode of Talking Trades. Of course, we have Kevin Wadsworth and myself, Patrick Karim. And Kevin, today we'll be talking to you about the nature of bull markets, how things maybe are different once you're in a bull market, how to use the indicators more efficiently. So I'll stop talking, Kevin, and I'll let you do the fireworks.
Yeah, sure. Thanks, Pat. Sounds easy, doesn't it? Sort of identifying and knowing that you're in a bull market and reacting and trading and investing accordingly. But how do you know that you're in a bull market? And how do you know that bull market is going to last for, 5 minutes or 5 years? How do you get that confidence? Because it's all about confidence when you're investing, particularly investing for a longer period of time. It's all about the confidence levels that you have sort of associated with that position. And that's what allows you to sleep well at night, along with risk and money management, of course, particularly with your trading. We've spoken about risk and money management before and just how crucial that is. But I'm going to use the gold chart, and I'm going to sort of show you how it was back in 2019 that we could be so confident and outspoken about the fact that we were bullish for gold and for precious metals back then. And I'm going to sort of point out for you, particularly how we're going to be able to identify when that time period is over and when the bull market is over for precious metals, and also how the technical indicators can be treated slightly differently during bull markets and bear markets. So here we are. We've got the chart for gold here. How do you know, or how was it that we were able to be confident back in 2019 that we were breaking out into a new bull market? Well, I've spoken about this before as well, and just having a couple of indicators on the chart is usually or is often enough to give you that sort of confidence level. And we tend to use moving averages and the Ichimoku cloud. And it's sort of well known that bull markets occur above long-term moving averages and above the Ichimoku cloud. We also add breakout lines, resistance lines. So when the gold chart broke out back in the early 2000s, you could see that confidence levels were high, that we were moving into a different environment here. We're above the Ichimoku cloud, above the moving averages, breaking out. We even had a nice little back test. So the same sort of thing was going on in 2019, and we've looked at this before as well. There was a nice breakout back test. The gold chart moved above the moving averages, above the Ichimoku cloud, and what was also very useful at the time was the fact that we had a nice cup pattern that was partially formed. So back in 2019, we had price had moved up and just came back and back tested and gave us a beautiful touch point on the edge of this arc here. Absolutely perfect. So that gave us a high degree of confidence in the fact that we were above the Ichimoku cloud and moving averages. And we've not changed our position since then. The correction that took about 3 years, the sideways correction, was entirely expected, entirely predictable. And it's what formed a very classic cup and handle pattern that you sometimes see with these charts. And there's your cup and handle. So confidence levels only grew, of course, when we broke out above the $2,000 area and started moving very, very strongly to the upside. So how else can we be, confident? How else can we get those confidence levels? And they come from things like gold versus the stock market. So if I just take a look at gold versus the stock market, and I do the chart for gold versus SPX, what we can see is very clearly when gold breaks out versus the stock market, to add to the confidence levels, what we're seeing or what we're witnessing is something called capital rotation. So the move back in 2019 just formed another point on this resistance line. And ever since then, we've been forming a base for the gold to S&P ratio. So confidence levels for the suggestion that we're not just in a gold bull market, but a gold bull era that will last like last time and like the time before in the 1970s for a decade or so, taking the price of gold up to $8,000, $10,000, $12,000. The confidence levels will become much higher when we break out above this resistance line on this gold versus S&P ratio chart. And that's because the impetus for gold, the power for gold to move by another, let's say another sort of $10,000 or so, is going to come from capital flows. And those capital flows will be given the sort of turbocharge that they need by hedge fund managers and by all of these entities that have large positions in gold and bullion banks and all the rest of it, recognizing the fact that gold has had a cyclical breakout versus the stock market. And it doesn't happen very often. It happens every 20 years or so. You get these sort of cyclical rotations between the stock market and gold. So it's all about confidence levels. It's all about identifying when these breakouts occur. Now, if I go back to the gold chart, you'll notice underneath I've got the distance from moving average indicator there. So that's showing how far the price of gold is from its 3-year moving average. And this behaves slightly differently. And I'm just going to put one of the stochastic indicators on as well. This is the stochastic RSI indicator that a lot of traders and investors use to spot the sort of ebbs and flows of the markets. Now, you'll notice that during the bull market, the indicators, or the stochastic indicator, moves to the high point and then it completely resets. Then it moves to the high point again and it completely resets. But if you just look at what the price is doing above, each one of those resets, the price doesn't move down very much, does it? It just moves down a little bit. So you then get a rapid acceleration to the upside. So in other words, each time in a bull market, each time you get this happening with the indicators, whether it's the RSI indicator or the TSI indicator or whichever indicator you happen to use, each time you get that nasty downwards reset, the price will only do something like that. Whereas you look at a similar move here where the indicator resets, and in fact, in this case, it's not even resetting quite as far as the previous example, and look at what the price did above. It fell all the way down here. So identifying whether you're in a bull environment or a bear environment is central to interpreting how much you need to worry about the resetting of indicators. And also, I should point out that this upper indicator, the distance from moving average for gold, is something we really should take notice of, because when this becomes extended in a bull market, what happens is you get a more significant pullback and consolidation that can last, in this case, from sort of March of 2006. It didn't really break out until August of 2007. So over a year or a year and a half of the price of gold sort of just consolidating before a big breakout move. So when you get stretched, and you'd have to say that we are getting very stretched now. Okay, so maybe it's going to become even more historically stretched, but we have to be aware of the fact that even though we're in a bull market, this could quite easily result in a significant pullback and correction. And you could quite easily imagine the price of gold, I don't know, moving up to $4,000, then pulling back to $3,000 before its next big upside move. And that may take the course of many months for that to happen. So watching the indicators is really important in both in bull markets and bear markets, of course, but identifying which of those you're in, Pat, whether you're in a bull or a bear market, will help you to interpret the signals that are coming from those indicators and help you to put all of those pieces of the jigsaw puzzle together and to react accordingly. Of course, your actions are going to be very different depending on whether you're a longer-term investor riding the trend or whether you're a short-term trader wanting to take advantages of those pullbacks when they happen. And that's it.
That was crazy, especially that gold versus SPX chart, Kevin, man. If that thing breaks out there, whoo, gonna be crazy. All right, guys. I hope you enjoyed that masterpiece by Kevin. And make sure to like, subscribe, and keep following. Thanks, guys.